I published a blog post earlier today that discusses a few bond, stock, and stock fund trades that I've made since my last two substantive posts that were published on February 10th, 2025. At the end of this post, I've included a snapshot of my mint condition 1987 Mercedes 260E, which I said I would include in that post in my last YouTube video. This post will use three examples to discuss interest rate risk for bonds. And if you're not interested in bonds, you can quit listening to this video right now. One of the bonds has no call protection and no make-whole provision in the prospectus, but sells at a significant discount to par value with a 2066 maturity. Another has a 3-year call protection and a 2050 maturity, and one has a make-whole provision and matures in 2035. All have credit ratings higher than BBB+. This post will be understood better since the topic is somewhat complicated, particularly if you're unfamiliar with these types of issues. By looking at my discussion of two purchases in the post published earlier today, March 18th, I'm referring to item 2F, where I discuss a purchase of a 5.25% Entergy Texas first mortgage bond maturing in 2035 at below par value. And this one has a make-whole provision that is reproduced in a snapshot in that post. And it needs to be, if you haven't read a make-whole provision in a bond prospectus, you sort of need to read that in order to understand what I will be discussing later in this video. And in 2G of that post, I discuss a 5-share add to an exchange-traded first mortgage bond issued by Entergy Louisiana that has a symbol ELC. And that one has a $25 par value and was bought at $20.75, a 17% discount to par value. On the stock exchange, it trades like a stock. And that one has a 4.875% coupon with a 2066 maturity, unless called early at par value. There is no call protection and no make-whole provision. A call at par value can occur at any time, and that would be at $25 per share. The third bond is that I've entered in order to buy, which hasn't been filled yet, is a one bond purchase with the issuer being J.P. Morgan. The coupon is 6%, and it's being offered through Fidelity's corporate note program, where retail investors can buy newly issued bonds at par value. These bonds will generally have limited call protection, and this is the case for this particular bond. The JPM bond matures in 2050, but may be called at par value starting in March of 2028 and every quarter thereafter. While the JPM bond has a A1 from Moody's, A from S&P rating, it is a senior unsecured bond issued by a bank holding company whose bond owners would be in a world of hurt when and if the FDIC seizes the operating bank. Consequently, I'm far less comfortable with the credit risk for that bond than with similarly rated first mortgage bonds issued by utility companies. What is a make-whole provision and why is that relevant in the Entergy Texas first mortgage bond purchase that is discussed in item 2F of this recent post that I published at my blog at the Blogger website? You can access that by going to just clicking on South Gen and you'll see the link to TennesseeIndependent.com. The make whole provision is designed to protect the bond owner from the interest rate risk associated with an early call during a period when interest rates are declining, and the issuer would benefit by calling the bond and refinancing it at a lower coupon. The protection will require a premium payment to par value for an early redemption in that kind of scenario, which attempts to compensate the owner for calling a bond during a declining interest rates scenario where interest rates have declined significantly below where the coupon of this bond is, which is 5.25%. If the interest rates for example, for an A-rated corporate bond falls to 3%, and there was no make-whole provision, then Entergy Texas would take the bond away from me at par value and refinance at 3%, leaving the owner with proceeds that can be invested only in a 3% similarly rated bond. The make-whole provision in this example would require, as a condition to an early redemption, the payment of par value plus the sum of all interest payments remaining for the bond, discounted to present value using the yield of a similar maturity treasury bond or note, which would have a lower yield than the corporate bond, and then you'd add 0.15% to that treasury yield that's used in the discounting mechanism. The provision frequently will operate to create call protection in this kind of scenario, since the premium payment would make the refinancing option undesirable to the issuer, or at least yielding no better result, because the make-whole payment would create such a premium payment obligation to par value in order to redeem the bond early. So having a make-whole provision levels the interest rate risk when the scenario is one where interest rates are declining. I'm talking about leveling the risk between the owner and the issuer. The J.P. Morgan bond creates substantial asymmetric interest rate risk in that the owner will be allowed to keep the bond when interest rates are surging, and JPM cannot refinance at a lower coupon. In this scenario, of course, the bond price would be falling. The option for the owner is to sell at a loss or keep the bond and lose the opportunity to earn more income by using the proceeds to buy a higher yielding bond, and both options are undesirable from the owner's standpoint. And liquidity for a retail note offered by Fidelity through its corporate notes program might not be that good. Given these issues, I decided to buy only one and hope that JPM calls the bond in March 2028 before I have to deal with the asymmetric interest rate issue. Maybe the 6% coupon will still be a good rate in 2028 or thereafter for some time. Maybe it will be a far too low rate and I will be allowed to keep the bond declining in value. or sell it at a loss. And unlike the bond that I'm about to discuss, there is no profit when and if JPM redeems the bond at par value. And this is important. The Entergy Louisiana bond can be called at par value now. That is fine with me since the last purchase would result in a $4.25 per share profit in ELC, the first mortgage bond that I'm talking about, which mitigates the interest rate risk associated with having to invest the proceeds in a lower yielding similar bond after redemption. I actually want to lose the bond at par value, that this bond ELC, and cannot say that about the JPM bond in a scenario when the reinvestment option for the proceeds is much lower than 6% and is made worse as the yield becomes even less favorable as interest rates surge beyond that coupon rate. So I said this was somewhat complicated.